You know, I've been asked 1,000 times in my life, Warren, what do you think about Bitcoin? And for years I've given the same answer. I say I don't understand it. Not because I'm old, not because I'm technologically illiterate, but because when I look at Bitcoin, I see something that doesn't have a foundation. It doesn't produce anything. It doesn't pay dividends. It doesn't have cash flow. It's just code sitting on computers around the world, and people believe it's worth something. But the belief is the only thing backing it. And belief by its very nature is unstable. It changes, it evaporates, it can disappear overnight. But then something happened this week that made me think about Bitcoin differently. Not because I've changed my mind about what it is, but because what happened to Bitcoin revealed something profound about how markets work, how people think, how fear spreads through systems like electricity, through copper wire, and most importantly, how ordinary people get hurt when they confuse hope with value, when they confuse price momentum with fundamental strength, when they believe that this time is truly different from every other bubble in history. Bitcoin fell 23% in a month. It went from $126,000 to $94,300. And in that fall, I saw something I've seen many times before. I saw the exact moment when belief becomes panic, when consensus becomes chaos, when the crowd that was buying realizes something that the smart money figured out weeks ago. The crash is the symptom. The real story is what caused it. And understanding that story, understanding the mechanics of how a bubble forms and then collapses, that's what separates the investors who survive from the speculators who get wiped out. Let me tell you what I've learned about moments like this, because I've lived through enough of them to recognize the pattern by now. I've built my entire investing career on recognizing these patterns, on seeing the same human behaviors repeat across decades, across markets, across different assets. Gold, real estate, tech stocks. It's always the same story. Fear builds, consensus forms. Everyone believes. Then reality intrudes, and the rush for the exits begins. First, let me paint you the picture of what happened. In just 1 month, long-term Bitcoin holders, the people who believed in this asset more than anyone, sold 815,000 Bitcoins. That's the largest exodus since January 2024. These weren't day traders looking for quick profits. These weren't people who didn't understand what they owned. These were true believers. People who held through 2022 when Bitcoin crashed 65%. People who told their friends it was the future of money. People who believed in the narrative so deeply that they thought Bitcoin would eventually replace the dollar, and now they're running for the exits. Think about what that means. The true believers are leaving. The people with the strongest conviction are selling. If they're selling, who's left to buy? If the people who were supposed to hold for decades are taking profits and cutting losses, what does that tell you about where we are in this cycle? It tells you that the psychology has shifted, that doubt has crept in, that maybe, just maybe, people are starting to realize that belief alone isn't enough to sustain an asset indefinitely. But here's where it gets really interesting, really telling. The outflows from Bitcoin spot ETFs hit $870 million in a single day. That's the second largest outflow in the entire history of these funds. Think about that. People didn't just sell Bitcoin. They sold their Bitcoin through the safest, most accessible vehicles available. The vehicles designed for people who don't want complications, for people who want simplicity, for people who want to believe they're making rational, measured bets in an irrational asset class. These are not sophisticated traders. These are regular people, people who probably saw Bitcoin going up and thought, I should own some of this. Everyone says it's the future. I don't want to miss out. Those people are now getting out. And when regular people start getting out, it means the easy money has already been made. It means we're in the end game of the cycle. It means the professionals already took their profits weeks or months ago. And to top it all off, more than $1.1 billion in cryptocurrency positions got liquidated in 24 hours. Over $1 billion Not lost to some hack or market malfunction. Lost because people were betting with borrowed money, leverage. They borrowed money to amplify their gains when Bitcoin was going up. They thought they were being clever. They thought they were maximizing returns. They were actually maximizing risk. This is always how leverage works. It's beautiful on the way up. You borrow $90,000, you add your own $10,000, you buy $100,000 worth of Bitcoin. Bitcoin goes up 10%. Now you have $110,000. You've made $10,000 on a $10,000 investment. You've doubled your money. That's incredible. That's the dream of the small trader. But Bitcoin goes down 10% instead. Now you have $90,000. You've lost your entire $10,000. You're wiped out, not just of your profits, of your entire stake. And your lender's calling. They want their money. They're forcing you to sell at the worst possible time, at the bottom, locking in losses. This is always how it starts. Not with a bang, with a whimper, with the first people getting nervous, then a few more. Then suddenly everyone's looking at the exits at the same time. And the exits, they're not big enough for everyone. The selling accelerates. The price drops further. More people panic. More margins get called. More forced selling. It becomes a cascade. Now people are asking me, is Bitcoin going to crash more? Is it going to zero? And I tell them the same thing I tell them about any speculative asset when it's in free fall. I don't know the exact bottom, but I know the pattern. And the pattern is always the same. First the believers leave. Then the regular people leave. Then the leverage gets unwound. Then what's left is capitulation. Pure capitulation, where the last people holding are forced out at prices that make no sense. You see, I've watched this movie before, twice actually, and I know exactly how it ends. In 1980, gold hit $850 an ounce. Everyone said it was going to $2,000, $3,000, maybe $5,000. People were terrified of inflation. They were terrified of governments. They were terrified that the financial system was breaking down. And gold looked like the answer, like the only safe asset, like the only thing that would preserve wealth when everything else was collapsing. In 4 years, just 4 years, gold had gone from $100 to $850. That's a 750% gain. The investment of a lifetime, people said. The only thing that will protect you, people believed. Money managers were recommending it. Newsletters were screaming about it. Regular people were getting second mortgages to buy gold coins. The consensus was absolute. Gold was going higher. The dollar was dying. This was the new reality. Then Paul Volcker, the head of the Federal Reserve, did something radical. He raised interest rates to 20%, not 2%, not 5%, not 10%, 20%. The highest interest rates in a generation. It was brutal. It crushed the economy, but it broke inflation's back. And it made gold unattractive because now you could get 20% returns in treasury bills, risk-free, and within 2 years, gold crashed 65%. People who bought at the top in 1980 didn't get back to even in nominal terms until 2008, 28 years. That's how long they waited, just to get their money back. No gains, no returns, no compounding, just waiting. Meanwhile, they could have owned Coca-Cola, which grew every single year, paid dividends, and became worth far more. They chose the metal. They chose to wait 28 years for nothing. Then in 2011, we had the same thing again. Gold rallied from $700 in 2008 to $1,900 in 2011. The financial crisis was fresh. People were terrified. The government was printing money, quantitative easing. The Fed's balance sheet was exploding. The dollar was going to collapse, they said. Gold was the only thing that mattered. It was the only safe harbor, the only store of value. It was going to $5,000 an ounce. The economic system was breaking down. The new world order was coming, and in that world order, gold would be king. And right on cue, same pattern, same psychology, same certainty. People calling for $5,000 gold. Writing books about it, making documentaries, creating newsletters dedicated entirely to the gold boom, the end of the dollar system, the beginning of the new monetary order. This time was different, everyone said. What happened next? The crisis passed, the financial system stabilized, the government didn't print us into hyperinflation like everyone predicted. Unemployment came down, the economy started growing, corporate earnings started recovering, and suddenly gold didn't look so appealing anymore. And it fell 45% over the next 4 years. People who bought at the top in 2011 lost nearly half their money. And it took years just to recover, years of holding a dead asset while the stock market tripled. Now here's what matters, the pattern. Gold up 750% in 4 years. Consensus builds, everyone agrees. Consensus seems unshakable. Then something shifts and suddenly everyone's running for the exits at the same time. Bitcoin up, 4,000% over a few years. Consensus builds. Everyone agrees. Everyone believes. This time is different, they say. We're not in a bubble, they insist. This is the future of money. Now it's crashing 23%. And the question everyone's asking is the same question they should have asked in 1980 and 2011. Is this the beginning of a much bigger decline? Is this the moment when the consensus breaks? Is this the moment when the believers become sellers? Is this the beginning of the capitulation? I think the answer is yes. I think we're at the beginning, not the end, because the psychology behind Bitcoin's rally is exactly the same psychology that drove gold to $850 and gold to $1,900. It's fear, pure fear. Fear of the dollar, fear of governments, fear of central banks, fear of the financial system. And fear is a terrible long-term investment thesis because fear eventually subsides when things don't get worse, when the catastrophe doesn't arrive. When life goes on and the system keeps working, fear evaporates. Let me explain why Bitcoin is different from gold and why that difference matters enormously. Why it makes Bitcoin even more vulnerable than gold was to a crash. When I say I don't understand Bitcoin, people think I'm being stubborn. They think I'm a dinosaur who doesn't get technology. They think I'm threatened by innovation. But that's not it at all. I understand technology. I understand code. I understand how decentralized systems work. I own Apple stock. I've invested in companies that use blockchain technology. I'm not against innovation. What I am against is confusing innovation with value creation. What I am against is believing that technology alone creates investment returns. Gold, for all its flaws, has a 5,000-year track record. When empires fell, people held gold. When currencies collapsed, people held gold. When governments debased their currencies, people held gold. Gold has been a store of value longer than any modern currency has existed. It has chemical properties. It's rare. It's incredibly difficult to counterfeit in any meaningful way. It can't be created by a government decision. It can't be printed into oblivion. It just exists consistent, unchanged across millennia. Bitcoin, on the other hand, exists as code. It's 6 years old, 16 years. That's not history. That's not even a full market cycle. That's barely enough time to see how a system behaves under real stress. And what do we know about Bitcoin's behavior under stress? We know it goes down faster than almost everything else when people panic. We know it's highly correlated with stocks when people are scared. We know it offers no protection when you need it most. You see, Bitcoin was supposed to be uncorrelated with stocks. It was supposed to be digital gold, a hedge against systemic risk, a protection against government overreach, a currency that couldn't be controlled by central banks, the ultimate diversifier, the ultimate insurance policy. But then when the stock market goes down, Bitcoin goes down too, and it goes down more, much more. When fear rises and people panic, Bitcoin falls faster than everything else. When uncertainty spreads through markets, Bitcoin gets hit hardest. That's not a hedge. That's not insurance. That's a speculative asset with extremely high volatility and zero intrinsic value. That's a trading vehicle for people who are betting on price momentum, not investing in something that produces value. There's a fundamental difference. One is investing, one is gambling. Think about what you own when you own Bitcoin. You own a piece of software. You own the belief that other people will want this software in the future. You own the hope that Bitcoin will become the reserve currency of the world. You own the faith that governments will fail and people will need an alternative. That's it. That's the entire value proposition. There's no business underneath, no earnings, no cash flow, no products or services that people actually need, just code and belief, just hope and dreams. Now contrast that with what I own at Berkshire. When I buy Coca-Cola stock, I own a piece of a business that makes products that billions of people consume every single day. That business generates tens of billions of dollars in revenue every year, tens of billions, billions in profit, billions that are reinvested, billions that are returned to shareholders as dividends. That company innovates, it adapts to changing markets, it survives recessions, it thrives in good times. It's been around for 150 years and will likely be around for another 150 years. When I own farmland, I own something that produces crops every year. The crops feed people. People always need food. Rain or shine, recession or boom, depression or expansion. The farmland produces year after year, compounding value, getting better with better technology, better seeds, better fertilizers. When I own a railway, I own infrastructure that moves goods across the country. As long as the country trades and produces and consumes, the railway is useful. It generates revenue, it pays dividends, it survives crises because commerce never truly stops. People always need to move goods. What do I own when I own Bitcoin? I own hope. I own the belief that cryptocurrency is the future. I own the bet that governments will fail. I own the fear that the dollar will collapse. And I own the fervent prayer that enough other people will buy it from me at a higher price than I paid. That's not investing. That's not building wealth. That's speculation. That's gambling. And gambling, by definition, has a winner and a loser. For every person who makes money on Bitcoin, someone else is losing money. It's not creating value. It's just transferring it from the believer to the early seller, from the late buyer to the early seller. Now, let me talk about what's really happening right now in the Bitcoin market, because the crash isn't random, and the psychology behind it tells us everything we need to know about where this goes next. Bitcoin has rallied 4,000% over several years because of fear of the dollar, fear of inflation, fear of geopolitical instability, fear of central banks printing money, fear of governments failing. Every time something scary happened in the world, more money poured into Bitcoin. COVID, supply chain disruptions, inflation spikes, war in Ukraine, tensions with China. People thought they were protecting themselves. They thought they were being smart. They thought they were getting ahead of the curve. But here's what actually happened. They were front-running the fear. They were betting that fear would get worse, that the economic system would break down, that the dollar would become worthless, that governments would fail, that capitalism would collapse, that Bitcoin would become the currency of last resort. The only thing with value, the only thing worth owning, the question now is simple. Has fear actually gotten worse? Or have the real world conditions actually improved while Bitcoin was rallying on the illusion of fear? Let's look at the facts. Don't look at Bitcoin. Don't look at media headlines. Look at actual economic data. Inflation, which was 9% in 2022, has moderated to around 3 to 4% by late 2025. That's better, not worse, much better. The U.S. economy has added jobs consistently, month after month, year after year. GDP growth has been resilient. We haven't entered the recession everyone feared. The financial system hasn't collapsed. The banks haven't failed. The dollar hasn't become worthless. In fact, the dollar remains the world's reserve currency, more valuable than ever. Has the geopolitical situation gotten worse? Has it improved? It's complicated. It's always complicated. But it hasn't gotten so much worse that the economic system is breaking down. Life goes on. Commerce continues. People still go to work. Businesses still operate. The system keeps functioning. So what we're seeing now is a reckoning. The real world conditions don't match the fear that drove Bitcoin up, and investors are realizing maybe this time wasn't different. Maybe the economic system isn't breaking. Maybe the dollar's still fine. Maybe there's no need to own digital currency to protect myself from systemic collapse that isn't happening. Maybe I bought at the peak based on fear that never materialized. Maybe I got caught up in the hype. Maybe I need to cut my losses and move on. And that realization, combined with technical factors like liquidations and ETF outflows, creates a cascade. People sell. That pushes the price down, which triggers more sales, which pushes it down further, which triggers margin calls, which forces more selling. And suddenly, what looked like a fortress of consensus becomes a stampede for the exits, a rout, a panic. Everyone trying to get out at the same time. This is exactly what happened in 2000 with dot-com stocks. Companies with no earnings, no profits, no realistic path to profitability, trading at astronomical valuations because everyone believed the internet would change everything. They were right about the internet changing everything, but they were wrong about which companies would benefit and by how much. And when reality intruded, when it became clear that most of these companies would go bankrupt, the selling was vicious. The losses were permanent. And in 2008 with real estate, everyone believed housing prices would go up forever. That it was a safe investment, that you couldn't lose money in real estate. People bought houses they couldn't afford, borrowed on properties they already owned, leveraged themselves to the hilt. Then housing prices stopped going up, started going down. And suddenly, people were losing their life savings, their homes, their ability to borrow. The pattern is always the same. Fear builds. Everyone agrees. Consensus seems unshakable. Then something shifts, and suddenly everyone's running for the exits at the same time. Now I need to talk about something important, something that most Bitcoin advocates won't acknowledge, and that's the role of leverage and speculation in this market. The people who are getting wiped out right now, the people who are losing money, many of them borrowed money to buy Bitcoin. They got margin loans. They leveraged their positions. They essentially made a bet with borrowed money that Bitcoin would keep going up forever, that it would compound at these rates indefinitely, that they could take on 10-to-1 leverage and multiply their returns. This is classic speculative behavior. It's what happens at the end of every bubble. People don't just invest their own money. They borrow to amplify their returns. And as long as the price keeps going up, everyone makes money. You borrow $90, add your own $10, buy $100 worth of Bitcoin, Bitcoin doubles, you now have $200. You pay back the $90 you borrowed, you keep $110, you made more than 10 times your money. But the moment the price stops going up or starts going down, the math flips. Suddenly they're not just losing their money, they're losing money they borrowed. And they're getting forced to sell by their lenders, forced to lock in losses, forced to capitulate. I've seen this before. In the housing bubble, people borrowed money to buy houses. When housing prices stopped going up, when they started going down, millions of people lost everything, not just their down payments, their entire net worth. Some even ended up owing more than their houses were worth. They owed $500,000 on a house worth $300,000. That's the power of leverage in reverse. The same thing is happening with Bitcoin right now, just in smaller numbers because fewer people are involved, but the principle is identical. You can't build a stable financial system on leverage and speculation. It always ends the same way, in crisis, in pain, in ordinary people losing their life savings because they believed that this time was different, because they thought they were smarter than the market, because they thought they could time the market or beat the market or get rich quick. Here's what I want you to understand. The people making money on Bitcoin right now, the ones with smiles on their faces, they're the ones who bought early and are selling into strength. The people who got in at $5,000 and are now selling at $126,000, they're taking money off the table. They're converting their Bitcoin holdings into real assets, into stocks, into real estate, into businesses that produce actual value. They know what's coming. They're getting ahead of it. The people losing money, they're the ones who bought late because they heard about how much money could be made. They're the ones who believed the narrative. They're the ones who thought Bitcoin was fundamentally different from every other bubble in history. The ones who thought this time was different. And they're discovering that it's not. That human nature is the same. That fear and greed work the same way, whether we're talking about Dutch tulips in 1637 or Bitcoin in 2025. So what happens next? Where does Bitcoin go from here? I can't tell you the exact price. That's not my game. I'm not a market timer. I don't predict what will happen in the next week or month. But I can tell you the pattern. I can tell you what history suggests about assets that have rallied this much on this little fundamental justification. Bitcoin could go to $5,000. It could go lower. It could go to $50,000 and then crash to $5,000. Could take months or years. The time frame is uncertain, but the direction is clear. The psychology has turned. The fear premium has started to collapse. And in speculative assets, once the psychology turns, it turns hard. It accelerates. It becomes a rout. More sellers will come. They'll come from regular investors who got burned. They'll come from hedge funds taking losses. They'll come from exchanges trying to manage risk. They'll come from people who bought at $100,000 and are now at $97,000 and terrified of going lower. Each wave of selling will trigger more selling. Each crash will inspire more people to get out while they can. And eventually, Bitcoin will find a floor. But that floor will be far, far below where it is today. Now, some people will say I'm wrong. Some people will say Bitcoin is going to $500,000, that it's the future, that I just don't understand. And maybe they're right about the future. Maybe 50 years from now, Bitcoin or something like it is a major part of the financial system. I don't know. I can't predict the future. No one can. But I'm not interested in maybes. I'm not interested in what might happen in 50 years if everything goes perfectly and no one can predict or control the system. I'm interested in what's likely to happen over the next 5 to 10 years. And I'm interested in risks and rewards and probabilities. In the math, right now, with Bitcoin at $97,200, down 23% from $126,000, I see a risk-reward setup that's terrible. Your upside from here, maybe Bitcoin goes to $150,000. That's a 50% gain. Nice, but not life-changing for most people. Your downside, Bitcoin could easily fall another 50% or more. Could go to $40,000, could go lower. That's a terrible bet. You're risking $3 to make $1. That's the opposite of what good investing is supposed to be. You want to risk $1 to make $3. That's how you get rich. That's how you build wealth. This is backwards. Let me talk about what actually protects you when the system gets shaky. Because Bitcoin won't, but something will. Over my career, I've made money through crashes by owning the right things. Not Bitcoin, not gold, not speculative assets, but real businesses with real competitive advantages, real moats. Coca-Cola, American Express, the railways and utilities that actually move goods and provide services that people need. During the financial crisis in 2008, when everything was falling apart, when the banks were failing, when the government had to bail out Wall Street just to prevent total collapse, I had cash, real cash, dollars, boring, unexciting dollars. And I deployed that cash into businesses that had gotten cheap. Goldman Sachs, General Electric, Bank of America. These were businesses with real assets, real cash flow, real value. Yes, they were in trouble, but they had intrinsic value, underlying value that couldn't go to zero. And when the crisis passed and economies recovered and the stock market came back, those investments made billions, literal billions of dollars. I could have lost everything, but I didn't, because I owned real businesses, because I was buying from a position of strength, not desperation, because I had cash to deploy when opportunities arose. But I could only do that because I didn't have my money tied up in Bitcoin or gold or other speculative assets. I had real businesses in my portfolio that pay dividends. I had cash set aside. Cash is boring. Cash doesn't sound exciting to people, but cash is ammunition. Cash is power. When crashes come, cash is worth more than gold or Bitcoin or anything else. I had a foundation built on productive assets. Assets that generate cash flow year after year, reliably, predictably. That's what protects you. Not digital currency, not precious metals that don't do anything, but businesses that generate cash flow, that adapt to change, that compound value over time. Businesses with moats, with competitive advantages, with management teams that think like owners. If Bitcoin goes to zero, you lose your entire investment. That's the mathematical reality. You own code. If the network fails, or if people stop believing, your investment is worth nothing. It can't go lower than zero, but it can go all the way there. Some people argue that Bitcoin can't go to zero, that the network is too big, that too many people believe. Well, Enron couldn't go to zero either. It did. MCI couldn't go to zero. It did. Lehman Brothers couldn't go to zero. It did. Lots of things that people thought were too big to fail, too important to disappear, they all went to zero. Anything without intrinsic value can go to zero. It's just code and belief. And belief is fragile. But if you own Coca-Cola stock and Coca-Cola goes out of business, which is about as likely as the sun exploding tomorrow, the company still has real assets, real property, real inventory, real customer relationships, real brands worth billions. You'd recover something, you'd have a claim on those assets, you wouldn't lose everything, you'd recover something, maybe not much, but something. That's the difference between investing and speculation. That's why I sleep well at night owning the businesses I own. And that's why I'd never sleep well at night owning Bitcoin. The risk is too high, the upside too uncertain, the downside too severe, the probability of loss too great. Let me bring this home. Let me tell you what I actually think about all this. I think Bitcoin is one of the greatest teaching moments in markets right now. Not because Bitcoin is the future, but because Bitcoin teaches us about human nature, about how fear spreads, about how consensus forms around ideas that feel true but aren't based on anything real, about how speculative manias start and end. Bitcoin taught millions of people about blockchain technology. That's valuable. It taught them to question central banks and governments. That's valuable. It taught them about the importance of hard assets and scarcity. That's valuable too. But it taught them the wrong lesson about what actually protects wealth, about what actually stores value over long periods of time. Bitcoin won't protect you in a real crisis. It will make things worse. Because when fear hits, real fear, when the system actually breaks, when unemployment spikes and companies fail and banks falter, people sell speculative assets first. They sell Bitcoin. They sell meme stocks. They sell anything without intrinsic value, and they run toward things that actually have value, toward real estate, toward productive businesses, toward cash, toward things that don't depend on belief. So here's my advice. Don't buy Bitcoin hoping to protect yourself. Don't buy gold hoping to protect yourself. Build a fortress of real assets instead. Own businesses with competitive advantages. Coca-Cola, Microsoft, American Express. Companies that adapt, that innovate, that serve real needs and generate real cash flow. Hold cash. Some percentage of your portfolio, not zero, cash that you can deploy when opportunities arise. When fear drives prices down and creates bargains, when real value is on sale, own real estate if you understand it, own farmland if you have the expertise, own infrastructure, own utilities, own things that generate income and have intrinsic value, own things that you can touch, things that you can understand, things that make intuitive sense, and be patient, be disciplined. Don't chase trends. Don't follow the crowd into speculative assets near the peak. That's how you lose money. That's how ordinary people destroy their life savings while the smart money is taking profits and deploying capital into real value. The Bitcoin crash from $126,000 to $94,300 isn't a buying opportunity. It's a warning. It's a signal that the psychology is breaking down. That doubt has crept in. That consensus is cracking, that the believers are becoming sellers. And when the believers become sellers, the cascade begins. I'm 94 years old. I've seen a lot of crashes. I've seen a lot of bubbles. I was there in 1987 when the stock market crashed 22% in one day. I was there in 2000 when dot-com stocks collapsed. I was there in 2008 when the financial system nearly failed. I was there in 2020 when COVID crashed, markets 35% in a month. And I can tell you with certainty, with absolute certainty, that this isn't the bottom. This is the beginning of the end of the Bitcoin mania. It might take months or years. The path down might not be straight. There could be rallies along the way that trick people into thinking the worst is over. But the end is coming, because manias always end the same: in pain, in regret, in ordinary people wishing they'd listened to the warnings, wishing they'd been more careful, wishing they'd asked more questions before they invested their money. You have the information now. You understand the pattern. You see the warning signs. You see the believers leaving. You see the leverage getting unwound. You see the fear starting to turn into panic. The question is what you'll do with that knowledge. Will you keep speculating? Will you keep hoping that Bitcoin goes to $500,000? Will you keep telling yourself that this time is different? Or will you start building real wealth in real assets that have stood the test of time? That's the choice. And unlike Bitcoin, the choice is yours to make. The ending is up to you.